Welcome back to the deep dive.
Great to be here.
Today we're unpacking a really interesting one. It's SERV Robotics, ticker symbol SERV. They're in that autonomous last-mile delivery space.
Right, the little delivery robots you might start seeing around.
Exactly. So if you're curious about their financial health, where they're headed strategically, well, you're definitely in the right place. We're going to give you that shortcut to getting up to speed. And for this deep dive, we've pulled together, our usual stack of sources. We've got the official Q2 2025 earnings release from SERV itself, but we've layered in real-time market data too. Think Zacks, NASDAQ, FinViz, TradingView, the works.
Yeah, and the mission, as always, is to cut through all that noise for you. We want to move past just the headlines.
Yeah.
We'll use our 5-part framework to really structure this so you'll understand not just what happened in Q2, but maybe more importantly, why it matters for the company and, what might be coming next.
Perfect. All right, let's get started. First up is what we call the at-a-glance scorecard. This is like our high-level snapshot, right? How they did versus expectations and the market's first reaction. Now for slide 1, the at-a-glance scorecard.
Okay.
So let's look at their headline performance for Q2 2025. Total revenue came in at $642,000.
Right.
That's actually a pretty solid jump, up about 37% from the same time last year. Q2 2024 was $468,000. So good top-line growth there.
Yeah, definitely seeing growth on the revenue side.
But then we hit the net loss, and that widened, well, substantially, almost $21 million loss this quarter.
Oof.
Yeah, it's a huge increase, like 130% from the $9 million loss they had in Q2 last year. So, they lost a lot more money.
Significantly more.
And that flows through to the diluted earnings per share, the EPS. That's a loss of a 36 to 6 for Q2 25, which is about 33% wider than the $1.27 loss last year.
And just a quick point on that diluted EPS. It's meant to capture the potential impact of things like stock options. But for SERV this quarter, their basic and diluted shares outstanding were actually the same.
Oh, interesting. So no major dilution factored in there for this period.
None in that specific calculation for Q2 exactly. It suggests those potential shares weren't quite in the money or didn't meet the criteria to be included right then.
Got it. Okay, so those are the raw numbers. How did they actually stack up against what Wall Street was expecting?
Well, it's a mixed bag, really.
Okay.
On revenue, that $642,000, it actually beat the consensus estimates. Zacks had it around $640K. Moo a bit lower. So yeah, a definite beat on the top line.
That's good news.
It is. But then you look at the diluted EPS, that $1.36 loss, well, it missed expectations. The consensus was looking for something closer to a loss of 23 or maybe 22.2.
Ah, okay. So a wider loss than analysts predicted, an earnings miss.
Precisely. Revenue beat, earnings miss, classic mixed result.
And how did the stock react immediately? Did the market focus on the beat or the miss?
It seems like the miss weighed a bit heavier, at least initially. In the trading right after the release, August 7th, SRV stock dipped slightly, about 0.24%, closing near $10.41.
Okay, not a huge drop, but negative.
Right. And Market Beat also noted a bit of a dip in after-hours trading. So that wider loss definitely tempered enthusiasm. Analyst sentiment seems, well, mixed, but leaning positive overall. Lots of buy ratings still out there, but you also see some more cautious neutral takes creeping in.
Understandable given the numbers.
Yeah, analysts are definitely pointing to the deepening losses and, frankly, the significant cash burn rate.
Right, that huge gap we saw, 37% revenue growth, but 130% jump in the net loss. That really needs explaining what's driving that.
Yeah, that divergence is key. There are really two big factors at play here. First, it's classic negative operating leverage, meaning their costs grew way faster than their revenue. Their cost of revenues, the direct costs of providing their service, just exploded. Over 970% year over year. Went from like $300,000 to $3.5 million.
Wow.
Yeah. So much so that they went from a gross profit last year to a gross loss this year of almost $2.9 million.
Okay, so costs just swamped the revenue gain.
Exactly. And it wasn't just cost of revenue. Total operating expenses, think R&D, sales, admin, more than doubled too, up about 127%. Now you have to understand, for a company like SERV, this is somewhat expected, maybe even deliberate.
How so?
They're in hyper-growth mode. They're aggressively investing, pouring money into expanding the robot fleet, launching in new cities, building the infrastructure. It's characteristic of an early-stage, capital-hungry tech company trying to grab market share fast.
Right.
Profitability comes second for now. It's a strategic choice, but yeah, it burns a lot of cash.
Okay, so factor one is exploding costs due to growth investment. What's factor two?
The second factor is simply the increased share count. The number of shares used to calculate that EPS figure, the weighted average common shares, jumped quite a bit, from about 34 million last year to 57.5 million this year.
Ah, so the loss is being divided by more shares.
Precisely. So even if the dollar amount of the loss hadn't grown as fast, the per-share loss gets worse just because you're spreading it thinner. And this increase in shares, it connects directly to how they're funding that growth we just talked about.
Equity raises.
Exactly. They've been actively issuing stock, pulled in over $75 million from common stock, another $13.5 million from something called an equity distribution agreement,
Yeah.
just in the first half of 2025. That's how they pay for the expansion, but the price is dilution for existing shareholders.
Right. Okay, so they're funding this big growth push by selling more pieces of the company, which makes the per-share loss look worse on top of the actual operating loss getting bigger.
Got it.
So what does this all mean for actual profitability? Let's dig into the margins. We're moving to the engine of profitability now. This section looks purely at their margins and the GAAP versus non-GAAP picture straight from their press release. Moving to slide 2, the engine of profitability.
Let's see it.
Okay, brace yourself for the margin analysis. The gross margin. It was negative 445% in Q2 2025.
Wow. Yeah, that's stark.
Stark is putting it mildly. It was positive 30% last year, so a complete reversal. Basically, their costs to deliver the service were like 4.5 times their revenue.
Tells you how expensive that fleet expansion is right now.
No kidding. Operating margin also got much worse. Negative 3,500% this quarter compared to negative 1,800% last year. Again, reflects those ballooning operating expenses.
Right.
And the net loss margin, it's over negative 3,200%. I mean, think about that. For every dollar of revenue they brought in, they lost more than $32.
Yeah, those numbers are extreme, but they tell a story. It's the direct result of that quadrupling the fleet, expanding into new markets, all that aggressive scaling management is talking about.
It's the cost of the build-out phase.
Exactly. They're prioritizing scale and market presence over immediate profit. It's a common path for these kinds of ventures, but it's expensive. What investors need to watch critically is whether these margins start improving as the fleet gets bigger and hopefully busier. That's the sign of operating leverage potentially kicking in down the road. That cash burn everyone talks about. It's just these negative margins made real.
So the hope is that as they scale, the cost per delivery or per robot goes down and the revenue per robot goes up, eventually flipping these margins positive.
That's the entire thesis, yes. But it's a long road.
Okay, now what about GAAP versus non-GAAP? Sometimes companies use non-GAAP to show a, let's say, adjusted picture.
Right. GAAP is the standard accounting rules. Non-GAAP pulls certain things out, often non-cash items, to show what management sees as core performance.
So SERV's GAAP net loss was that nearly $21 million, or a 0.36 per share. What was the non-GAAP?
Their non-GAAP net loss was lower, around $14 million, and the non-GAAP diluted EPS was $2.24 every cent.
Okay, still a loss, but significantly smaller. What are they adjusting out?
The big ones are non-cash expenses. Stock-based compensation was almost $3.9 million of the difference. And there was another $2.2 million adjustment related to a finance lease purchase option.
I see.
So management uses this non-GAAP view to say, look, if you ignore these non-cash or non-core items, our underlying operating loss is closer to this $14 million figure. It's a way to potentially highlight progress that GAAP might obscure.
But should investors rely on that?
They should definitely look at it, understand what's being adjusted and why, but always compare back to GAAP. Even the adjusted $14 million loss is substantial. It doesn't change the fact that the company is burning its significant cash and is far from breaking even overall. Non-GAAP can provide context, but GAAP reflects the full financial reality.
Okay, useful context, but the reality is still deep losses for now. Let's get more specific about where the revenue is actually coming from. Time for the engine room. We'll look at their business segments and operational stats here. Next up, slide 3. The engine room business segment performance. Okay, let's break down revenue performance by segment. They have two main ones, software services and fleet services. Software services brought in $296,000 in Q2. That was actually down slightly, about 5% from last year.
Okay.
But fleet services, that's the actual delivery revenue and branding stuff that saw really strong growth, up over 56% to $330,000.
Ah, so the big shift there.
Exactly. The revenue mix has totally flipped. Fleet services are now the bigger piece, about 51% of the total. Last year, software was dominant at around 66%.
And that makes sense, right? As they deploy more robots, the physical delivery side should grow. But it also has major implications for those margins we just talked about.
How so?
Well, analysts generally consider early-stage fleet or hardware-related revenue to be lower margin than pure software services. So this shift towards fleet dominance aligns perfectly with why we saw that overall gross margin turn sharply negative.
Right, the stuff that's growing fastest is also the most expensive to deliver right now.
Precisely. The press release doesn't break down profit by segment, unfortunately, but it's a safe bet that the fleet services expansion, while crucial for the top line, is currently dragging down overall profitability significantly. Investors really need to watch for signs that the margins within fleet services start improving as they scale. That's critical.
Okay, that's a key point. Now, what about the key operational metrics? How much did they actually scale?
This is where the numbers get really big. Daily active robots, up 233% year over year. They had 160 active daily in Q2 25 as compared to just 48 last year.
Huge jump, quadrupling, like they said.
Yeah. And daily supply hours, basically how much time those robots were available for work, that surged even more, up almost 350% over 1,700 hours a day. Massive increase in operational capacity.
So here's the disconnect again, right? Capacity up 200, 300%, but revenue only up 37%. Why the lag?
That's the million-dollar question, or maybe the $60, $80 million question based on their forecast. It really points to that build-out phase lag. They're putting the robots out there, getting the infrastructure ready, but they aren't yet running at full utilization or peak efficiency.
They're building the capacity before the demand fully fills it.
Or before they fully optimized how to generate revenue from that capacity. Remember, they're talking about quadrupling the fleet again in the second half of 25. Their CFO is projecting that $60, $80 million annualized revenue run rate once they hit 2,000 robots sometime in 2026.
Okay.
So the current financials reflect the cost of deploying those first few hundred robots, not the revenue potential of a fully scaled, optimized network of thousands. Success absolutely hinges on driving up revenue per robot, getting more deliveries, higher value deliveries, better utilization as that fleet grows.
It's a bet on future efficiency and utilization then. Let's see how they're positioned financially to make that bet pay off. Time for financial strength and shareholder rewards. We'll look at the balance sheet health. Now for slide 4. Financial strength and shareholder rewards.
Crucial slide for a company burning cash.
Indeed. Let's look at balance sheet health. As of June 30th, they had cash and cash equivalents of about $117 million. That's actually down a bit from the end of last year.
Okay, reflects the burn.
But they also had about $67 million in short-term investments. So you combine those, and their total liquidity is strong, around $183 million.
That's a healthy cushion.
Yeah, and management specifically said this should provide runway through the end of 2026. Which, given the burn rate, is vital information.
Absolutely critical. That runway is key.
Looking broader, total assets were over $214 million, way more than total liabilities of just $7 million. So fundamentally, a pretty healthy balance sheet structure.
Very asset-heavy relative to liabilities.
And almost no debt, right? The debt-to-equity ratio was tiny, like 0.034.
Yeah, very low reliance on traditional debt, which brings us back to how they are funding things.
Right. How do they have $183 million in liquidity when they're losing $20 million a quarter?
It comes from net cash provided by financing activities. In the first 6 months of 2025, they brought in over $100 million, almost entirely from selling stock. That $75.8 million common stock raise, the $13.5 million from the equity agreement, that's what replenishes the coffers.
So they're funding the operational cash burn by issuing new shares.
Exactly. It keeps the lights on and funds the growth, extends that runway to 2026, but it comes at the cost of dilution. The low debt level means less financial risk in one sense, but it also means existing shareholders are bearing the cost and risk of this expansion phase directly through that dilution. It's a common strategy for high-growth tech, but it's important to understand.
Definitely a trade-off. So given they need all this capital for growth, I assume there's nothing in terms of capital return like dividends or buybacks.
You assume correctly. The press release makes no mention of either.
Makes sense.
Yeah, completely expected for a company at this stage. They're in full investment mode, scaling up a capital-intensive business. Every dollar they have and every dollar they raise is going right back into building more robots, expanding operations, and trying to reach that critical mass. Returning capital to shareholders isn't even on the radar right now.
All hands on deck for growth. Okay, we've looked back, looked at the present situation. Let's wrap things up by looking ahead with management's view and our final takeaways. This is the road ahead. Finally, slide 5. The road ahead management's outlook and key takeaways.
What's the vision?
Well, management's outlook is pretty grand. The CEO talks about building a world where autonomous last-mile transportation is ubiquitous and foundational. Very visionary.
Big picture stuff.
Definitely. The CFO gets more concrete, confirmed the plan, quadrupled the fleet in the first half, planning to quadruple yet again in the back half of 2025.
Super aggressive scaling.
And that long-term target, aiming for an annualized $60, $80 revenue upon full utilization of our 2,000 robot fleet sometime during 2026. That's the big number they're shooting for.
That's the payoff target for all this investment.
And near term, for Q3 2025, they're guiding revenue between 600K and 700K. So that would be like 170% to 215% growth year over year. And they expect to more than double the fleet again just in Q3.
So the message is clear. Growth pedal is still firmly to the metal. This aggressive outlook, even with the current losses, really underscores that scale now, profit later strategy.
Right.
They're trying to build market dominance, achieve network effects quickly, and what they see as a nascent, high-potential industry. The losses today are viewed internally as a strategic investment to capture that future market. But, it's a strategy with risks.
Like needing continuous funding.
Exactly. It requires ongoing access to capital, which they've shown they can get via equity, but that can't last forever.
Yeah.
And it relies on a long, uncertain path to actual profitability. That $60, $80 million run rate target for 2026, that's the make-or-break validation point for this whole high-risk, high-reward approach.
Okay, that frames the strategy well. So let's synthesize everything. What are the main key takeaways from SERV's Q2?
I think there are 4 big ones.
Go for it.
First, it's clearly an aggressive growth strategy fueled by heavy investment. We see rapid operational scaling, which drove the revenue beat, but it's super capital intensive, leading directly to those widening losses and negative gross margins. It's an investment phase, not a mature profit phase.
Okay, number 1, growth investment driving mixed results.
Second, mixed financials versus expectations. Revenue beat, but the EPS miss due to higher costs. Highlights the challenge of managing expenses during hypergrowth, and we saw the stock react slightly negatively to that miss.
2, beat on top, missed on bottom.
Third, strong liquidity supports the scale-up. That $183 million cash in investments, largely thanks to equity raises, gives them that crucial runway through the end of 2026. They needed to execute the expansion plans.
3, they have the cash runway for now.
And fourth, that revenue mix shift towards lower margin fleet services. As the physical delivery side grows, it's currently dragging down overall profitability, shown by the negative gross margin. This absolutely underscores the critical need for them to improve their unit economics.
Right, you mentioned unit economics before. Can you elaborate just a bit more on why that's so crucial here?
Sure. It's really the core challenge long term. Success isn't just about having thousands of robots. It's about making each robot, or really each delivery, profitable. Can they lower the cost per delivery? That means more efficient operations, maybe less human intervention, cheaper maintenance, smarter routing, all that stuff.
Okay.
And can they increase the revenue per robot? Higher utilization, maybe premium delivery fees, advertising revenue, whatever it takes. So forget just the fleet size. Investors need to watch for improving gross margins specifically, rising revenue per active robot, and, critically, a falling cash burn rate over time. Those are the signs of efficient, sustainable growth, not just growth at any cost.
That's a great clarification. Efficiency is key, not just scale. So pulling it all together, what's the final narrative on SERV Robotics Q2?
I'd say it paints a picture of a company absolutely deep in an intense early-stage growth sprint.
Yeah.
The revenue beat shows the expansions is happening, partnerships like Little Caesars are contributing, but the much wider loss reflects the massive cost of that sprint, especially as the lower margin physical delivery business takes over. They've got themselves time with strategic equity raises giving them that runway. So it's a clear bet. Sacrifice profits now to build scale and dominate the market later. Long-term success totally depends on whether they can translate that scale into actual operational efficiency and high utilization down the road.
A clear narrative indeed. And that wraps up another deep dive. Hopefully, using this structured approach helps you, the listener, cut through the noise and really grasp the dynamics behind the numbers, performance, financial health, strategy. It's about building that deeper understanding.
Absolutely. And maybe a final thought to chew on. Given SERV's clear scale now, profit much later strategy, what specific signs of improving unit economics will you look for in their next few reports to see if this big, expensive gamble is starting to pay off?
Something to watch for. Now, the necessary reminders. This report is for informational purposes only. It does not constitute financial, investment, legal, or tax advice. Any investment decision should be based on your own research and talking with a qualified financial professional.
That's right. And remember, this report was generated by an AI model integrating the company's official release with public market data. Always double-check any data or calculations yourself before making decisions based on it.
Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.